Hello everyone and welcome back to the world's best investing podcast. Today I want to provide a bit of an update on Tesla, which I think is going to be quite useful for, I think, the mental model behind that explains the way that I see Tesla now will also likely enable you to navigate the volatility that we are seeing. Fundamentally, the way I summarize my Tesla thesis is that the stock has been trading sideways for over 4 years now, but the cars drive themselves. Why is that important? Because ultimately, the economy just consists of people and organizations processing information in order to figure out what action to take next, and then taking said action to deliver value. Now, the thing with cars driving themselves is that's actually the basis for a platform which solves autonomy across the board, and in my view, over the long term, creates a kind of internet which distributes autonomy tokens, as we see, pictures of cats and dogs being distributed today via the internet. And so that's important because although it seems like Tesla at times is just a kind of car company, it's actually not. It's an AI and robotics company. And the reason I was saying it's valuable today to think about this in terms of navigating the volatility. What drives stock prices up over the long term is free cash flow per share growth. Usually free cash flow per share growing much more than the market was originally discounting. If you see the price action that made Tesla get so famous worldwide, which was the price action going into the 2020-2021 period of time, it was essentially driven by a platform they had created, which was able to defensively put out lots of value in a way that the rest of the capitalist system couldn't. So they actually went through what Elon Musk called production hell in order to be able to efficiently and at scale produce the Model 3 in a way that really no one else was able at that time. So they were able to bring electric vehicles, specifically the Model 3, but then this applied to the rest of their models with a level of efficiency and therefore at a cost that no one else really could. And so that is how Tesla managed to scale quickly, delight end customers, and ultimately print much higher free cash flow per share, which is what drove the stock up tremendously, right? So you could say, I'm an early investor in this company. I first got in 2016, and I've been there since. And so this model about essentially companies having to build platforms that are able to produce value in a way that the rest of the system can't is important, because ultimately every additional dollar a company makes is an added incentive for the market to come in and disrupt, meaning you're not going to obtain 10, 20, 30, 40, 50x returns unless you find a company that's building a platform that can really durably enhance free cash flow per share in that way. So when we look at the volatility induced yet again by Jerome Powell's remarks today about tariffs pushing out value, their decision to, I suppose he was actually pointing to their decision to potentially lower rates. I actually don't care about that, as I don't really care about the macroeconomy in general, because I'm an investor in tech. And so, wait, my arm is getting a little bit tired. There we go. What happens is that I've seen this happen many times with my AMD investment and other investments. The macroeconomy can be turbulent at times, but most of the times technology companies that are able to produce this sort of platform, their earning power is perpendicular to the rest of the macroeconomy. So to give you an example at the extreme, at the limit, if someone today were to come and be able to produce NVIDIA's GPUs at half the cost and at twice the scale, then this company would automatically overnight be worth trillions of dollars. And so that's obviously an extreme example, but as an investor in tech, that's the kind of scenario that you're looking for. Now with Tesla, it's interesting that we've had a few years of inflation, rates have gone up, and so this has essentially made cars much less affordable, and that is why financially the company has been struggling. There's a number of aspects to the Tesla thesis that are very much worth digging into, which people generally don't. One of them is the idea of economies of scale shared, which is when Tesla achieves a certain level of profitability. Historically, what they've done is decrease prices for customers. So they end up using their scale to drive lower prices for customers over time. And so there's a number of metrics you can look at in order to assess that. But sometimes people confuse Tesla's declining profitability with bad news, and it's actually not. if you look at, I think the metric was, one of them was cash from operations divided by capex, which means ultimately how many units of cash from operations are you producing per unit, per dollar reinvested back into the business. That graph is actually cyclical. It goes up like this, up and down like a sine wave. If you're a little bit of a nerd, it just goes up and down. So people, when Tesla's profitability goes down, they don't actually understand that usually tends to correlate with the top of that graph of cash from operations divided by capex. That's a conscious decision that management takes to drop prices and ultimately deliver more value to customers per dollar spent on their behalf. And so then what Tesla does is work very hard in order to attain new levels of efficiency in order for cash from operations divided by capex to then rise up again. What happened with rates going up and inflation is that this cycle that I'm talking about was actually cut short. And by the way, you can refer to my Substack, which is linked to in my YouTube profile, in order to see this cyclicality. It's very, very important. Very few people talk about it. So this last cycle was cut short, ultimately because the affordability of cars went down dramatically as rates went up and inflation went up. So ever since that happened in around 2022, the company has been somewhat struggling financially. However, the end goal for Tesla now is much bigger than that. We were talking about platforms. So this is one platform that Tesla continues to compound, which is manufacturing. They are better at manufacturing than most other companies on the planet, and they continue to get better at that. The next platform is essentially using all this hardware that they are putting on the road in order to collect data about road traffic in order to generate autonomy. And so that is the big reward for investors down the line, because as I was saying, that's not only about cars, not only about getting cars to drive themselves, but also about infusing whatever other hardware device with autonomy, obviously humanoid robots, etc. Now, that future is not actually here yet. And so what we are forced now is us investors, tech investors, and by the way, none of this is financial advice. This is just me as a Tesla investor talking about it. This is a typical scenario in the life of a tech investor in which we are essentially forced to succumb to our intuition, because there is little data. Sorry, I just heard someone screaming at me here. There's little data about Tesla's alleged progress with humanoids, etc. So how do we think about this? Well, in my opinion, it comes down to just three metrics, which is one, the number of cars produced per year, which again can go up and down. Essentially the cost per car produced by Tesla. And let me just hold this like this. The cost per car produced by Tesla, and then the number of miles that people can drive on average with FSD, full self-driving, without human intervention. Why are these metrics important? Because ultimately, what you want as a Tesla investor over the long term is for Tesla to have more cars on the road than anyone else, picking up data, so sending it all back to a centralized data center where all of that data gets processed and then repackaged into insights which drive more autonomy, which in turn drives more cars on the road, driving on their own, producing more data, and ultimately yielding an intelligence that others can't, simply because they can't produce cars as cheaply in a similar volume, in a way that these cars are connected to this vertically integrated infrastructure, which really yields autonomy. So the prize for, in my view, for Tesla investors 5 or even perhaps even less, but I'd say 5 years down the line, is much bigger than what we saw in 2020, 2021, because this is really, the company is really bootloading an autonomy AI, which is going to be distributable all across the economy. Because as I was saying, the economy is just people figuring out what action to take and then performing the action in question. So this can be abstracted away by Tesla, because really once you figure out the autonomy for a car, you can do so, I'd say, relatively easily for other devices. Now, I've talked in the past about how actually, in order for the humanoid robots to work in a corporate context, they need to be connected to a digital twin. Because yes, humanoid robots will be able to most likely navigate three-dimensional space, but in order for them to actually produce value, they have to be connected to an exhaustive digital copy of your company's operations so that they know ultimately how to drive value across the enterprise. That is why I believe that actually Tesla and Palantir are set to either compete or collaborate, or a bit of the two, years down the line, and I've talked about this on X previously. Anyways, the way I'm looking at Tesla right now is, yes, there's financial volatility. Yes, the quarters can be confusing. But when you are in a multi-decade kind of thesis, this sometimes happens. Quarters are not always extremely fun to look at. Sometimes they are confusing. But to me, I was talking about intuition, and that's because a lot of the times the biggest picks come down to intuition for me. So for instance, there was no proof, no widely acclaimed proof for Palantir when I bought it, that this company was going to be the leader of digital twins worldwide. There was some science, it's highly qualitative, and I sort of stitched it all together in the form of intuition, and that's what led me to buy it. But no one was really guaranteeing that this was going to happen. The same is happening with Tesla now. But in my view, as I was saying, so long as they put more cars on the road that are vertically integrated with this sort of closed AI loop, and they do so more cheaply than others, they are ultimately producing a moat, which in my opinion is going to be comparable in strength to that of Google before the LLM disruption happened, which I think now it's looking a little bit flaky. So just think about it. In order for you as a company to compete with Tesla, you need to put out on the road as many quote-unquote robots as they do. And I'd say, well, the only company really in the West that's kind of close to doing so, but very, very far away from Tesla, is Rivian. I have some write-ups about Rivian on my Substack too. Very, very interesting, led by a founder operator, brilliant guy. But anyway, everyone is very, very far away from doing that. How much do I think a company like this can be? Well, trillions and trillions and trillions of dollars, much like Palantir. Because actually, although it may seem like a car company, it's a robotics company, and the economy is fundamentally made by autonomy. Once we have autonomy, which is distributable via an API, such as I think would be Tesla's autonomy years from now, then that's just a huge, huge business. It's well, think about it. The internet has produced tremendous wealth nowadays, and that's just information moving around, which is basically documents, images, videos, etc. The power of that when it's actually autonomy tokens moving around is tremendous, tremendous. So the thing with intuition is sometimes it works, sometimes it doesn't. But in my opinion, when it comes to obtaining multi-bagger returns, like 20, 30, 60x, as was in AMD, as was the case for AMD when it was up at $210, it really comes down to stitching together qualitative data, which is not so readily observable by the public at large. Now, it's funny with Tesla. The reason I summarized my thesis as, this stock has been trading sideways for years and now the cars drive themselves, is really, if you want to look at one KPI, is how cool the FSD videos are. These cars are driving themselves, which is pretty incredible. No one else is really doing that, at least in the West. And so long as I see these videos getting cooler and cooler, with FSD ultimately getting better, I think that to me, that's the leading indicator for me to continue holding this company. If you want to review the thing about cash from operations divided by capex and a number of other metrics that I look at, just go on my Substack, which is linked to in my YouTube profile, and check out all of my write-ups on Tesla, and you'll see how actually there's a very quantitative way to understand how Tesla produces value. And so you will see very clearly how over the past few years the market has been confusing temporary short-term financial pain for actual weakness, when actually what they are doing is investing in delighting customers worldwide. Anyways, guys, I'm off for dinner now. I had a wonderful day, although it's pretty cloudy out here. But anyways, happy Easter to all of you. Happy holidays, etc. Which however you say this worldwide. And guys, if you want to learn how to analyze companies like I do, check out my course. It'll be linked to in the show's footnotes. People love it. More than 500 customers have taken it now, and I have a 14-day money-back guarantee. So if you buy it and you don't like it, just so long as you send me an email in the first 14 days, you'll get a no questions asked refund. It's basically a summary of the mental model that I use to analyze companies and make multi-bagger investments like Tesla, which I'm up now 20x, Palantir, which I'm up 12x, Spotify 6x, AMD over 20x, etc. It also includes the breakdowns of my mistakes, which I've made a few of them. I've actually made a bunch of them in public with you guys. So it's basically a digest of everything that I have learned in the past decade in the stock market. I teach it to you in under 2 hours, just because honestly, I think I'm a pretty good teacher. It's a very powerful, very elegant mental framework. And you can go and check out on the course's website what real customers think about it. They love it. It makes me super, super happy that that you guys decide to trust me and take the course. And I absolutely, once you buy the course, you get access to the course's free Slack channel, in which you can talk to me directly, and I think now it's over 280 international investors. So then the value continues after you take the course. And I just love to see you guys over there participating with other deep divers, etc. Of course, if you don't want to buy the course, you can just enjoy the videos, enjoy the updates. Again, please go and check out my Tesla updates, write-ups, deep dive on the Substack, which I think you're going to love. Lots of great stuff that I don't see people talking about. And have a great day, and I'll see you tomorrow. And of course, it's always about the volatility. It comes down to, do we have much higher levels of free cash flow per share from here, or do we not? I believe we are going to see in select cases, but none of that is financial advice. So ultimately, it just comes down to holding on to world-class companies and ignoring the noise. So see you guys, and take care.